how do you become homeless in the first place? What happened there?
My dad actually lost his job. My mom, she was a minimum wage earner. They didn't have the financial education. We just couldn't afford, and they couldn't afford to keep up. So we ended up having to transition into a homeless shelter.
Would you recommend people starting in real estate, put in your own money and rack up credit card debts?
Absolutely not. It was terrible, man. I could have lost it all.
Are you still working the W-2 job?
No, so I haven't worked a W-2 job in over, I believe, 15 years.
When the lease comes up and the tenant decide that, hey, I want to stay, but I don't want to pay the increased rent, what will happen?
Oh, you gotta go. Automatic eviction. And the eviction process here is fairly simple, fairly fast. I think we can be out from the time we file eviction till the time we get you out, anywhere from 20 to 30 days. I don't usually take on anything with less than a 20% cash on cash return.
20% cash on cash returns. Guys,
yeah,
if you're Canadians, listen up, man. Now, if you look back at your entire portfolio, your entire journey of 0 to $140, but what was the major mistakes you make and you could have avoided now that you know what you know?
That is a tool, and it has to be used as such.
Ray, a lot of people read your stories, how you become homeless to owning 140 doors now. But I really want to know is, how do you become homeless in the first place? What happened there?
Yeah. So it wasn't like a tragic story of like drugs or abuse or anything like that. We lived in New York City, and in 2001, after September 11th, Twin Towers fell, or there was an attack. There was a big recession in New York City, and my dad actually lost his job. My mom, she was a minimum wage earner. They didn't have the financial education, and we just couldn't afford, and they couldn't afford to keep up. So we ended up having to transition into a homeless shelter.
Wow, so your whole family moved to it.
Yeah, so it was my parents as well as my 3 sisters as well. So it was a big family in a homeless shelter, if you can imagine.
Wow, remember those movies, what's it called, by Will Smith, The Happiness?
Yeah, Pursuit of Happiness, yeah.
Pursuit of Happiness, is that very similar to that kind of story kind of thing? That was kind of your dad and you were like the son?
Yeah. Unfortunately, my dad never made it big, but I think I did pretty well for myself.
Got it. So now you were homeless, and how did you come out of it, right? Did you start, how long did you stay in the shelter? And then what got you out of the shelter? What made you feel like it's enough to get out of the shelter?
Yeah, so at that point, I was actually pretty young. I think I was about 12 or 13. So there wasn't much I could do that was in my control. I was, just a teenager. But eventually we were able to get some government assistance. And that kind of helped prop us up. And from there, I remember I got my first job, I think, when I was 13 or 14. And I knew that I needed to help my parents out in any way that I could. And I think I was just cleaning dishes. I just knew that, this little piece of money that I was making would help my parents and stop us from becoming homeless.
So when you make that first bucket of money and say, hey, this is good enough so I can invest in real estate. Like, how do you get into the real estate in the first place?
Yeah, so
your own money, or how did that happen?
Yeah, so the money actually came from my money. I didn't even know what I was doing at first, to be honest with you. I had no idea. I think a lot of people get into real estate, they have no idea. They just know it's a good investment. So I had no idea. I used my own money. It was some from money I had saved from, my businesses that I had eventually opened, and some from, lines of credit, using credit, HELOCs, stuff like that. I used those funds to eventually get my first property.
When was that? When did you?
Yeah, that was about 10 years ago, about 2014, 2015, I believe.
10 years ago, so that's about 2013, so 2014. Right? About 2014?
Yeah, about 2014, yeah.
Would you recommend people starting in real estate, or starting any business like you, like put in your own money and rack up credit card debts, line of credit? Would you recommend people doing that now?
Absolutely not. It was terrible, man. I could have lost it all, but at that point, I felt like I didn't have much to lose, and I had already lost so much in my life. I wouldn't recommend it now. There are smarter ways for people to buy if they understand how to invest.
So what is that smarter way if they know how to invest? What is that secret sauce?
I don't think it's any secret sauce. I won't give it that jazz, but I mean, it could be anything from seller finance, subject to, Purchasing properties the right way, raising capital. There are tons of ways that you can get in without, having to use your own money.
I know, yeah. Subject to, we have listeners from Canada and US. For subject to, can you explain it for Canadian people so they understand what subject to means?
Yeah, so subject to, I think in Canada they may call it vendor take back. And that might just mean buying the property under the terms that are already set without having to go to the bank and pretty much taking on a person's debt.
Basically, assuming mortgage.
Yeah.
Simple words. In Canada, subject to is not as popular. Assuming mortgage is not as popular because we have a shorter term of our mortgages. So, they just kept getting renewed and all that. But in US, you can get even up to 40 or 50 years
Yeah.
of the mortgage term that you don't have to renew, right?
Hmm.
Now, you scale from 0 to 140 doors. And if I remember correctly, you said it just now, you only recently started raising capital. So
Yeah.
how were you able to keep growing from 0 doors to 140 doors and you were not raising capital? How did you do that?
One, I didn't quit my W-2 job. A lot of people, they start making money, they want to quit their job. But there's nothing wrong with having a W-2. Continue to invest, right? I don't care what position. If you're giving capital to somebody to raise or you're raising capital your own, continue to invest. And at that point, even though I had a couple doors, I still kept my job. I was still continuing to invest. My strategy didn't change. I made wise investments as well that helped fuel my journey and help me scale. The real estate should work for you. It should help you scale if done correctly.
Can you, what was your job as a W-2? What were you doing? Are
So,
you still working the W-2 job?
no, so I haven't worked a W-2 job in over, I believe, 15 years. Um, I was
How old are you now, Ray? Just so people know.
I'm 34.
Okay, you're 34, so same age as me, right? Born in 1990, kind of thing. Or
I'm 89, so
1989.
I turned 30. I turned 35 soon, but yeah.
Okay, so you haven't worked a full-time job for 15 years. So you started when you're 20.
Yeah.
Wow. So what were you doing for the last 15 years? Not working a W-2 job then?
I got into an entrepreneurial spirit and I started my first food truck. It was a taco truck. I started a taco truck. I had a partner at that time. They helped me and we went in together. And I started opening other businesses. I opened a restaurant. I opened a bar, and I continued to use those funds to fuel other investments. However, if anybody knows, being in a restaurant bar business, it is very tedious and very time consuming and very stressful. And I wanted something that I could take my foot off the gas a little bit and still make money. And real estate was that.
Do you still own those restaurants and bars?
I do. I've put in some great systems, and they still pay me every month to this day.
Well, just for people who doesn't know, I heard this saying of 333. So one third goes to labor, one third goes to material, and then you kind of take home one third. Is that accurate for restaurant and bar business?
Absolutely not. It is in restaurant and bar business. It is like you take home 1/10 if you're lucky. I think the average restaurant makes about a 7% margin on a good restaurant, right? So if you do 1 million in sales, you might make 70,000. So those aren't great numbers. Those not great return. But if done right and structured right, there are great returns you can have.
Sorry, go for. Yeah, I was saying, I think that it seems like the risk was so high for such a little return on profit margin,
Yeah.
right?
Yeah, it was. It was. I just didn't know any better though. For me, that was the thing I knew. I worked in restaurants. I had worked in bars. So it was just, that's what I knew.
So, can you bring us through your journey then? I know you stopped working W-2 at 20, and then you start your entrepreneurship in restaurants, bars, that you still own that until today. But how does that fuel your real estate investing journey up until 140 doors? Tell us the exact thing you did. It could be right, could be wrong, could be something to reflect on, but I think a lot of people are really interested, right? They just hear from, okay, 0 to 140. Okay, I'm like 10 now. I'm like 20 now. I'm just
Yeah.
getting started now. What exactly did you do to
I
get to
use
140?
yeah. So I think one problem that happens with a lot of people is they get that first income, 5 doors, 10 doors, and they don't use that money to continue to invest. They take it, they go buy cars, they go buy a bigger house, they go buy jewelry, which is great. But I didn't do that. I kept using every dollar I used to fuel that beast. And I look back now and it's like, wow, we have grown this right now. And it just became, you know what? Every dollar I get, I'm gonna put back into investing. Some people take only 50% and invest it. I take 100%. Right? I have income sources coming from other places. So if I really want to scale, if I want to get to that 200, 300, 1,000 doors, what do I need to do to get there? And that is fuel the beast or raise capital.
So up until now, the 140 doors is all you, 100% owned by Ray.
Yeah, I've taken on
Is that
partners
correct?
for about 5 of my doors, I believe.
What do you think about these real estate investing when everyone is raising capital, do it with joint ventures, syndication deals, uh, create a fund? What is your viewpoint on that?
So I have no problem with people doing it. For me, that is not my strategy. I am more of I don't want to report to anybody. I've been free for so long. I'd rather just not have to report to anybody. So I don't have to go to my LPs and say, hey, look, this is the report for this year or for this quarter. I'd rather just know at this quarter I've made this amount of dollars and this is where this property sits. I don't have to ask, is it okay if we cut the grass or anything like I like owning it and being able to sleep at night.
But then you start raising capital, isn't it?
Yeah.
So now
Yeah.
you got to start reporting to people.
Yes.
So how do you make that decision?
So that's all systems put in place at that point. Who am I going to partner with? Whose capital are we taking? How many people are we taking? There's times you can raise capital and you can have 100 investors. To me personally, I don't want to get to that scale. I think that becomes a big nuisance at that point because you have 100 people to answer to. When I raise capital, I look at everybody I'm raising with as more partners than just raising capital. I want a fruitful relationship. And I think even GP, LP, you should still want a fruitful relationship as well.
Yeah, I think everyone wants fruitful relationship, but how did you look for a fruitful relationship? I know you're the GP, right? What are
hmm
you looking for in the LP, and what should an LP look for in a GP to have a fruitful relationship when they are invested in multifamily?
I think both ways goes track record, number one, right? What is their track record? What type of results have they produced? For a GP, the last thing you want is your LPs up your behind every month saying, hey, what's going on? What's this? What's this? You want to be able to execute at a high level. And so as a GP, you need that space almost to be able to execute at a high level, and no distractions. And then as a LP, I would look at it as what has this person done? Have they been able to successfully raise capital, take down deals, get investors a return? What have they done?
So how do you go about and show can you talk about your recent deal that you just started raising capital, or we cannot talk about it yet?
Not yet. That's top secret. We can't talk about
Ah,
that.
okay. Okay, top secret. So people gotta follow Ray, and maybe by the time this episode comes out, you guys can go ask Ray, or I'll probably know as well, but not yet. Okay, okay. So I guess a lot of people might have this question too. I have the same thing. Should I keep buying smaller deals on my own, or should I become an LP, limited partner? Just investing my capital and sit back, just write the check.
Yeah.
Which one would you prefer? Which one would get more, like, how do you analyze this? Even for you, right? How do you analyze this?
I think that's a great question, Cody. I think it becomes who the person is, right? Whoever's asking that question, you have to understand, hey, am I willing to take on more work? A LP is literally you just sit back and you might collect a paycheck, right? Whereas the GP, there's more work. If you take it on by yourself, there's a lot more work. There's risk to reward. As an LP, you don't have as much money in it. Sometimes the LPs have individually, they might have less than a GP individually. So how risk averse are you? How much work do you want to do would be I think the best question to ask yourself when it comes to answering that question.
So how do you personally make that decision and say, hey, because you went from a guy that said, I don't want to report to anyone,
Yeah.
to now and say, I'm going to become the GP. Again,
Yeah.
the deal is unknown right now, but you're going to start raising capital, have a lot of responsibility, and you
Hmm.
got to report to a lot of
Yeah.
shareholders now,
Yeah.
right? And how do you analyze that? Is it because you want to scale, or what was your thought
Yeah.
process?
100% is one, how big this deal is. What's the return? Is it something I really feel comfortable taking on by myself? I'd rather have people spread it out and we can all take this down. Everybody get a piece of the pie, right? And I think that's the best way when raising capital. Just understand, like, hey, look, we can all get a piece of the pie and everybody can eat. So that's when I look at it as maybe this one is a little bit too big for me to take down by myself. We're talking 50 doors, 100 doors in one swipe. That's a big deal. It's a big undertaking.
Mm, mm. Yeah, it could be a big undertaking if it's bigger like that. Now, is bigger deal having better returns after all these hassles? Is it really worth it?
Again, that's a tough question because it depends. Each deal is totally different. I've known people who raise capital and they, at the end of it, they're like, never again, right? Like it was too much work and I made the same amount of money I would have did, investing in a couple single family units. I made the same return and then my money was locked up, for 5 years or 3 years. So I think, again, this is very specific to each person, understanding what you're getting into before and knowing the exit strategies after.
Mm, mm, mm. And how do you make sure that if people are thinking about that, how do you, we don't have to talk about the structure, but how do you really set this up so it's a win-win for both sides? How do you set this up? Because you talk about each deal is different, right?
Yeah.
Is there something you aim for? Is there something you're targeting? Making sure they're targeting a certain amount of return so it makes sense? Or how do you make that decision then? Is
Yeah.
that,
Yeah.
okay,
So,
we're going to pass on this deal we're going to take on because this, right?
yeah.
What
So
is your tolerance?
one of my indicators is going to be cash on cash return, the money we're putting in, and then the money we're going to be getting out of it. I think that's one of the key targets. Rate of return, another key target, or annualized return, what we're aiming for is a key target. Those are two of the biggest factors I'm looking at. Then also the value add, right? So if I'm raising capital, there has to be a part of my exit strategy for everything that I do is a value add. How are we going to force value on this? Are we going to rehab these apartments to raise rents? Are we going to are the rents under market? Can we force value that way? What things can we add or subtract? Can we make the landscaping a little bit better? Go from softscape to hardscape. Could that save us on the bottom line, helping our NOI, net operating income? What things can we do to help make this as streamlined as possible?
Mm, okay. Got it. Yeah. I think everyone's like really looking for like a hard example. I know current deal you cannot talk about it. Can we talk about your previous deal? That's the biggest deal. How many unit was it? Kind of where is it? And then we can go through that example. How's that?
So my previous deal was, I'll tell you, was a subject to. It was 1 point. Actually, it was seller finance. It was seller finance. 1.2 million. Um, 10,000 down, and this was a 6 units maybe. Mixed
Six
use.
unit?
Yeah, mixed use, commercial and residential.
Okay. So how many residential, how many commercial?
Four residential to commercial, or yeah, four residential to commercial.
And this is where?
This is in West Virginia.
West Virginia. That's where you won the awards for 40 under 40, in case
Yes.
people don't know.
Yeah.
So 1.2 million, 6 unit per unit is kind of like $200,000 then.
Yeah, the commercial you run a little bit different because there's great room for increase plus triple net leases. So, but yeah, about 200 a unit.
Tell us about the triple net leases.
So yeah, triple net. The tenant pays taxes, insurance, and you made me forget the other one. Taxes, insurance, and I can't think of the other one.
Texas insurance and said the
Yeah, the acts too fast. Um, Maintenance, taxes, and insurance.
okay.
Yeah.
So tenants pay maintenance, tax, and insurance.
Yes.
How does that impact on on your actual deal?
Oh, it's great. So triple net leases are what you really want because the rental amount that you're getting is net to you. If you say, hey, Ray, I got a single family house and I make $2,000 a month, gross, what's the net to you? Well, you have to subtract the taxes, insurance. You have to subtract all that. Where in commercial, we don't subtract that. That is, if I say I make 2,000, that's 2,000 net.
And so when you bought this deal for 1.2, take us through this journey.
Yeah.
What did you do? Like
So,
how, okay, before you even got in, why do you think this is a good deal? How do you do analysis?
so I have a calculator that I use. You can get on my website. There's several calculators you could use to figure out how to take down a deal, something of this nature. One, we're going to run the numbers, make sure that it cash flows.
This one, this specific one. Tell us this specific one. What makes you take the leap of faith and say, yeah, we're taking down this?
So one, the numbers cash flow, right? I knew that once I ran the numbers that they would cash flow as it sits. Two, the markets were under rent, or they were under market. The rents were all under market when I analyzed it. So I knew
How
there
much
was
under market?
probably about 17 to 18% per unit. Right? So
Both
that's huge.
residential and commercial are
Commercial,
under.
yes, huge, huge. We had some leases coming up that were going to end, so that meant we could, get new tenants in faster, which then it meant we could increase rent. The location was a great location, and then finally it was a subject to deal. So on this $1.2 million deal, I went to closing with about $10,000.
Yeah, it's very like hard to wrap your head around before someone did a subject to, because it's literally taking over a mortgage. You take down 1.2 million deal with just $10,000 of your own money,
Yeah.
right? And then do you have to do any construction to
Yes.
value add?
Yeah, so we ended up doing some value add, probably about 120,000, which meant new roof, new HVAC units, and some upgrades to the tenant spaces to help for example, the commercial tenants. We didn't have to, but we installed some new HVACs, and that then gave us the okay with them to say, hey, look, sign a new lease with us. We'll do these HVACs with you, and we'll just bump up your rent just a little bit. And they were more than willing. They'll save that on the electric bill, hopefully, or they'll save it somewhere else. So they know they're under market, with a great location. So, but they've all
Yeah.
agreed to stay.
Hey, Wellbusters, I just want to put on a side note, I do not run any ads on this channel. So if you enjoyed the video up until this part, make sure you like, subscribe, and share with a few friends that can benefit from this. And let's get right back into the episode. Yeah. And in West Virginia, it's very, in USA, we talk about the blue state, the red state, right? The tenant friendly, and but then you get a very interesting thing going on because it's mixed use. So 4 of them is residential, 2 of them is commercial. Commercial is pure business. It's easy, right? If you don't pay, you're out, right? Residential is, can depend on which state you're in. If you're from California or Seattle, good luck. But if you're in West Virginia, is that a tenant friendly state for a landlord to?
Landlord friendly over here.
Not landlord friendly, or tenant
No,
friendly?
it is. No, it is. It is very landlord friendly here in West Virginia. Yep.
So you have no problem basically say, hey, when the lease comes up, you can just easily turn over if they don't agree to pay the higher amount, right? They just have to move out. And what if they don't move out?
I lost you right there. When the lease comes up.
Yeah, when the lease comes up, and I say, when the lease comes up and the tenant decide that, hey, I want to stay, but I don't want to pay the increased rent, what will happen?
Oh, you got to go. Automatic eviction. And the eviction process here is fairly simple, fairly fast. I think we can be out from the time we file eviction till the time we get you out, anywhere from 20 to 30 days.
Yeah, that sounds very landlord friendly, for sure. Maybe that's why you love West Virginia so much.
Yeah.
So keep going on that journey. Then you spent about, you spent $10,000 to close on a $1.2 million deal. You add in about $120,000. Then what?
Right now, so we got new rents in. They're renting at market and above market rate right now. And commercial tenants, like I said, have renewed. So we have this asset established and cash flowing. So that's what makes it a good deal for me, is it cash flowing. And then also my rate of return, my cash on cash return. That deal sits pretty well. I don't usually take on anything with less than a 20% cash on cash return. Right? So
20% cash on cash return. Guys, if you're Canadians, listen up, man. So like, some numbers, right? 1.2 mil. What is the value at right now? Did you try to pull money out, move on to the next deal? What
No,
is it?
no, I won't pull money out of it because the interest rate's so good. So
What's the
I
interest
think
rate right
I
now on
think my
that
interest
deal?
rate on this one is about 3%.
Mm,
So it's 3% amortized over 30 years.
mm.
So I'll probably I'll just use that and ride the debt till I'm done. You know?
But if you were to sell it now, how
Yeah.
much can you sell it for? What is the appraisal amount?
So I'm not sure, we haven't had it appraised recently, but we think if I was to list it, probably like 1.8, 1.9,
Wow. So like you,
just based on the cash flow and NOI.
wow. That sounds like a killer deal, right? Bought it for 1.2, put in 100K, 120,
Yeah.
right? Of your own money. And if you were to sell it, you can sell it for 1.8 million.
Yeah.
Wow, that sounds like a killer deal, killer deal. And what are some of your exit strategy then? What if you say, found another deal, you want to get rid of this one? What's your exit strategy when you come in?
So the goal is never to sell, right? I don't like to sell. Um, and so if we need to, one, like I said, I buy properties with the intent of cash flowing,
Mm,
right? So when I get it, I know, okay, this is going to cash flow, 5,000, 10,000 a month. If I need to go take something else down, we should have the capital ready to take it down, right? If we need to, we have other properties that we can refinance. In my portfolio, I have other properties that I could tap into the equity. However, the interest rates are the best right now. So, I have a lot of properties with some trapped equity. And a lot of people
mm,
don't talk about that, but I have several properties with trapped equity. It makes no sense to refinance it.
mm,
The cash flow, just hold on to the cash flow and weather the storm.
mm. Yeah, I have quite some properties like that, 50% loan to value. Everyone's like, there's a lot of debt equity. I'm like, well, the moment I refi, it doesn't make sense. So,
Yeah.
like, and so like for those people that were, you know, stuck in those negative cash flow property, maybe they bought right at the hype of 2021,
Mhm.
right? They're stuck. They have to renew. Like, what would you tell them?
Get out of it. If you have to renew with new debt right now and you're already negatively cash flowing, get out. Like
Get
there,
out as in what? Just sell it at a loss?
sell you. I mean, what's your other option? At this point, what other exit strategy you have? You could probably try to sell a finance. If somebody's willing to take on a debt and may see an upside to it, but if you're not making money off these deals, get out of them, right? And here in the States, we wouldn't buy anything that negatively cash flows. And people who do buy stuff that negatively cash flows, hoping on appreciation, they usually see foreclosure first.
Mm, mm. That's very powerful. Very powerful there. So even if, some people are luckier like us, if we're gonna sell, we already have equity in it. So even if we sell at a lower price, market already adjusted, we sell at a lower price, we still net proceeds. But some people's like bought it right at the hype. Like, Ray, I'm like, if I sell it now, it's 300K loss. I put in so much work and sweat equity into it. What about my sunk costs, right? What about my sunk costs?
Yeah, I mean, here's the thing: if new debt is coming because you guys have to refinance every 5 years, correct?
In Canada, yes. In
Yeah, yeah.
US, you don't have to, right?
In
Depending.
U.S., you don't have to. Yeah, so I mean, in U.S., sometimes commercial, the bank might rewrite your rate, and every 5 years they might reanalyze your deal, commercial side of it. But for the most part, they usually let it be. But for example, if in Canada you have a deal that barely is cash flowing, it's going to start negatively cash flowing. If
Mm,
you want to hold on to that, I don't know. Like, there's your money could be treated so much better in other places, right? And I give this analogy: if you have a vehicle, right, and you're putting into that vehicle $100 a month, right, and the vehicle barely is running, and then you get another $1,000 a month problem, is it worth it to keep that vehicle? Right? This might be a rare vehicle, or you might think it has some, but the thing is, this vehicle is not getting you to where you need to go.
mm. That's a good metaphor. I think a lot of people just couldn't get over the mindset, this is my baby. When I got in, this is off market deal. This is a great deal.
Nah.
Now the market turned. Like, to help people get over that hump, or like a lot of my students, a lot of my clients are real estate investors. They diversify to set and done strategy of ours, right? Stock option investing. We only do S&P 500 index, so we don't have to pick stocks. But before people go and diversify that, they still want to free up some capital. So can you help share one of your experience, if you have one, that you have to bite the bullet, take some loss, or just take less profit so that people can take that courage and help them, showing them that it's possible?
So you're asking me about a story that didn't go as planned, or a property that really didn't go as planned?
Yeah, yeah. Some of your like
Yeah.
failure
So
story, really. People love hearing those. And how
yeah.
do you
So
deal with those?
my first two deals actually, they were great. They cash flowed great. I think my first two, I was making $1,000 per door, and this was several years ago. So that was great cash flow, and I wanted to scale up into a bigger, 8 unit deal.
Mm,
And I made the mistake of selling the units for what I put into them. So I sold them and broke even. But there's no such thing as breaking even, because you have what we call capital gains tax in the U.S. And I didn't really break even. I had to pay tax on that. And if I had known better, I would have refinanced instead of selling
mm,
it. But I
mm.
thought selling was the only strategy at that point to raise capital or to make money to get into the bigger deal. So I sold those two, and those were some of the greatest assets. I put a couple thousand, couple grand into these doors, and they were cash flowing like month over month.
So what you learn from that is sometimes refinancing is better than selling. But for people who are like negative cash flow right now, renewals coming up, you're telling them to sell right away. Would you still make the same decision? Or would
Yeah,
you tell them to say, hey, refinance your negative cash flow, but use the money you refinance to keep funding the deal and then ride it out? Like,
you could try to write it out, but then what happens if rates don't go down? Now you got more debt. So
mm,
they're like, here's the thing. Like, I would never recommend anybody in my community, anybody on my team, in my mentorship, to ever buy a deal that negatively cash flows, right? Unless you have a dramatic upside. Like, hey, look, we can renovate this property. But if it's barely cash flowing, if you're breaking even, there's no such thing as breaking even in real estate. There is no such thing as breaking even in real estate. Because guess what? When something breaks, it's going to break you. You're the one that's going to have to pay.
yeah. Tell
You
me
might
about
want
it.
to pick that up. That might be a good one.
Tell me about it. Yeah. I just saw your recent video about making Airbnb. Everyone talks about how much money they make, but no one talks about all the work you put in, how much time of the turnover, the expenses, and all that, right? You want to
I
say
hate
something
it.
about that?
I hate Airbnb, man. I hate the actual operation of Airbnb. I have Airbnbs, and pretty much it becomes a break even. Like, as a landlord, if my rent's at market rent, I'm gonna make a couple $100 more, but then have to deal with a lot more headache, a lot more of the management side. To me, it's typically not worth it. I'd rather have a long term tenant. You also have everybody's like, hey, look, I made this much this month, but they never talk about, okay, I had to have this expense, or I had to pay this cleaning fee, or or the tenant broke this, or the tenant smoked in a house, and now the whole house smells like smoke, and they never talk about that, and so they only show you the glitz and glam, and it's just not real. Like, there is a lot of downside to the Airbnb, wear and tear on your unit, people in and out, dealing with them. It's a job. It's a hospitality job.
Now, why, if that's the case, why do you think people keep doing Airbnb? Because in Canada, when we do Airbnb, like I have Airbnb myself, we got about double of the long-term rent. So it's enough for us to have, expense goes in and still make money on it, right? And instead of a team, have more turnover of tenants. Now we're leaning more towards like mid-term rental. But in the summer high season, we still like short-term rental, because sometimes per night we can get $1,000, right? Whereas, the long-term rent in that house is probably 3,000 to 3,500, right?
Yeah.
So, like, why do you think people keep doing that then?
I think there are some great operators in the space. There are some really good operators in the space. Some people have, niche places. They have like these really cool, but then there's a lot more losers than there are winners.
Mm,
And a lot of people don't talk about the losses that they had. They only share the good wins. And I see it all the time. Oh, I got a booking for $4,000 or $5,000. That's great. I got a booking for 10 grand. That's great. But what about the people who didn't get booked, right?
mm,
Whose places are sitting vacant right now, or people who invested with the mentality of, I'm just going to Airbnb this and I'll make money, but then are barely breaking even on their rent or their
mm,
mortgage payment.
mm, mm. Yeah, I mean, this is my takeaway, because about 2 years ago, I almost went all in Because at that time, my wife's just, considering about switching career. I'm like, hey, maybe you can look at this Airbnb thing. Right now, our Airbnb has 45-star reviews, doing well. That was a house originally we built to move in. So it's top of the market and all that. And she's managing well because she used to be a branch manager at the bank. So she's really good with customer service and all that, right? But for normal people, would you say that Airbnb is almost, like, there's not enough margin in it to really, unless you at scale are a really good operator.
Yeah.
And people don't talk about, like, the turnovers of things. If you, the landlord don't let you do it, and some people do the Airbnb arbitrage thing, right? And they don't really own the property. They don't have any depreciation. They don't have any appreciation. They just keep moving from A to B, B to C, C to D kind of thing, right? They don't talk about that. Can you find a way that's still be successful in Airbnb then?
Arbitrage could still work. You don't have as much risk. I guess you could just leave if you wanted to versus a landlord. Here's the deal. Like, if you get into Airbnb, one, it's a numbers game, just like getting into real estate. How much will this cash flow? How much will it make? And is it worth my time? Right? Like you mentioned, people don't talk about the cleaning fees. Unless you have it at scale, you're going to pay a ton of money for cleaning fees. Right? They don't talk about furnishing it. It's it's expensive. I think I just spent probably about $4 or $5 so far just to furnish a 2-bedroom. Right. So now not only do I have to make the base rent, but I got to make $5 on top of that to break even. Then it's also the time into managing that. Now I hired a virtual assistant to manage mine, but there's still time that I have to recoup costs on. Right. If your wife is managing it, how much is her time worth? What is her salary worth? Is she making enough to compensate what she would make at the bank? Those are the things that I think about when it comes, because it's operating a business. And here's the thing: we don't get tied to real estate. Nobody in my mentorship, nobody that I deal with in my community, there is no tie, there is no love. This is numbers. This is a business, and we operate it as such.
So, like, I think you have a lot of rent on the Airbnb side. We both own some, so we talk from operator standpoint. I'm lucky that mine is very successful, but there, every year we have to keep adjusting and all that. Now, if you look back at your entire portfolio, your entire journey of 0 to 140 doors, what are some of the key lessons you learned? Key mistakes that could have break you, but it didn't. And you're lucky. Sometimes a lot that's luck too, right? Yeah. The market help us, the rent help us. Woo! But what was the major mistakes you make and you could have avoid now that you know what you know?
Honestly, it would be refinancing some of the properties that I refinanced. Right? Some of these properties, I'm like, man, I should take out more money to help me scale. And it did help me scale. But then I thought, okay, well, I could refinance at a better rate. Well, guess what? Now the rate hasn't gone back down. So I've scaled. But now some of these properties have bad debt on them. And I wish they're not terrible debt. I'm still cash flowing. But it's not as good cash flow as it could be. So now I have to wait for those rates to drop. So I can't really scale like I want to at this point.
Got it. And thanks for sharing that, Ray. Like, I think a lot of people listening to this can relate. That's a reality of things. When there's a balance between equity and debt, again, for normal people, I just say, how much are you leveraged? If you always goes, leverage to the maximum, right? You pull out the most money. When the rate double or triple, you are going to be in trouble, right? And the property that have some equity, sure, but if they don't have equity, you have to sell, you're going to be in big trouble. So it's almost like the people in the last 2-3 years, if they scale too fast, they might go belly up. But if you don't scale, you don't pull out the money, then you feel like the return's not there. So now that you know that, you describe that, what is your balance now? How do you balance the scaling and then the cash flow side of stabilizing business so you don't have some keep going belly up and then keep scaling and blow up?
Yeah, I think the biggest thing is buying good deals, right? You can't pay full price. And I think a lot of people that we see that are facing these troubles, they pay full price, right? And we buy for pennies on a dollar, or we get them with good debt. We structure it from the beginning with, multiple exit strategies. We don't rely on, okay, if I refi. We don't rely on, hey, I have to sell this to get to my end. We want to have 3 exit strategies for every deal. So maybe it might be a flip. I might hold it long term. what's going to be my exit strategies? Those are the biggest things that I'm looking at to help me, stay well balanced in my portfolio.
Yeah. So if anyone's feeling that way, the deals you bought from 2-3 years ago is kind of under the water and all that. Yeah. We feel all of you. Just, do it accordingly. If you have to cut loss, you cut the arms to keep the body, do it, right? And don't scale too fast. And like, a lot of people don't agree with Dave Ramsey, right? Of zero debt. What do you think about that? What do you think about Dave Ramsey? He's like, no, don't get on any debt to get into real estate or business. What do you think about that?
Dave Ramsey works for 90% of the people in this world, though. A lot of people cannot handle debt. A lot of people cannot. It is a skill to handle and manage debt, and most people cannot do it. So I think Dave Ramsey applies to that 90% of people who cannot do it. For the 10% who do, they do well, right? If you want to grow and scale fast, you need debt, right? And it could be your debt might be in the form of other people's money. It could be that syndication. That might be your debt, but you need money to scale. And if you try to work your way, if I would have tried to get to 100 doors without debt, it would have been impossible. I would have been on door number 5, maybe. So debt is a tool, and it has to be used as such.
And right now, with all your deals going forward, is there like a loan to value that you aim at? Don't go higher than that. Do you put more money down? If it's not a sub 2, how do you mitigate the risks? I know I don't know if you heard this, but everyone is like, Cody, there's a lot of wealth transfer right now, right? All the baby boomers are retiring, and they're at the richest generation in history right now. So you're going to pass on a lot of things. They're going to sell a lot of things. Now it's a good time to buy. But how do you mitigate that and when the interest rate is high right now, or high, relatively high to the past years, but they might stay here, go up. Most people are anticipating to go down. But how do you navigate this?
We don't care about interest rates. Real investors don't care about interest rates. Does a deal cash flow now or not? Right? Will it cash flow 5 years from now? What if the interest rates go to 15? Is that a good deal? Right? A good deal will withstand interest rates. A good deal will withstand and weather the storm. Right? So if I buy something, I'm buying a deal. I think we closing like next week or the week after. I think my rate is 9.25% on a commercial deal. I don't care.
Okay.
Cash flow.
That's same as ours. It's a bridge loan, right?
It cash flows.
Yeah, from day one. Same as us. It's a bridge loan. Sounds like it, right?
Yeah, it cash flows. So that's what we buy with the intention of, does this cash flow from the beginning? It does. Let's go.
Okay, I really want to hear about that deal, but I know you probably can't talk about it yet because so many reasons and all that. But is there any other thing that you really want to share with our audience, knowing that they're high income earners, they're on their way to their own version of financial freedom?
Yeah, right? One, you're already listening to Cody, so you already know that you're doing the right thing. Spend time getting the right circles, learn about investing, whether it be syndications or you're lending money to help others raise capital, or whether you're investing on your own. Get around the right groups and the right people to help you stay motivated.
That's good. Well, where can people find more about you or your free training?
Sure. So every Tuesday, 6:30 p.m. Eastern Standard Time, I offer free real estate training. If you're interested, you can find it. You can find me on Instagram, Ray Glymph, or you can find me on just on my website, www.rglymph.com, and you can just join a free class.
So go follow Ray. Ray's went from homeless to 140 doors. Of course, do all your due diligence and don't scale too fast, right? Do what makes sense for you. Everyone has a different situation. What works for us two might not work for you, but this is our story, right? So with that being said, thank you, Ray, for coming on. Okay. And we're probably going to have you back again once you close that deal.
Appreciate it. Happy to share with you after.
If you're watching until this point, make sure you like and subscribe, and we have more episodes like this waiting for you, so stay tuned. And if you don't mind, give us a 5-star review so more people like yourself can enjoy episodes like this.